Greetings, everybody. Welcome to Liberty Call. Today is Wednesday, March 8th, 2023. Hope everybody's having a good day out there. It is hump day. Go get your, what was that, Progressive, I think, had the Camel? Or was it Geico? I forget. Anyways, not important. If it's your first time watching Liberty Call, please give me some big old thumbs up, likes, shares, subscribes, follows, all that good crap. Looks like the market kind of, pulled out of its tailspin that it was in from yesterday, at least for the NASDAQ and the S&P 500. The Dow was still in the red. It didn't make it back above the midpoint all day. NASDAQ was mostly in the green, and then the S&P 500, worked its way back into positive territory before the close. So we'll see if that's good news. Everybody freaked out yesterday because they thought the world was falling apart, but we shall see. All right, well, let's go ahead and jump into the numbers and see how things turned out today. Dow Jones was down 0.18%, closed at 32,798. S&P 500 up 0.15, closed at 39,92. NASDAQ up 0.4%, closed at 11,576. The VIX fell 2.45% today. It's at 1911. Canada was up 0.35, Brazil up 2.08, and Mexico up 0.59. Our friends over the Atlantic, Germany was up 0.46, UK up 0.13, France down 0.2, Netherlands up 0.24, Spain up 0.58, Italy up 0.54, Switzerland down 0.35, and Portugal up 0.43. Russian exchanges were split again today. MOEX up 0.06, RTSI down 0.72. And, maybe they were closed. Yeah, they're the same. So that's the same as yesterday. So they must have, their markets must have been closed today. Maybe it's a holiday for Putin's birthday or something. Who knows? And then the overnights in Asia, mostly red, starting out with the Nikkei in Japan. It was up 0.48. Australia down 0.77. Chinese markets, the Shanghai was down 0.06. The SESC component down 0.09. China A50 down 0.8. DJ Shanghai down 0.13. Hang Seng down 2.35%. And the Taiwan weighted down 0.25%. All right. So looks like the overnights are pretty ugly, but not so bad in Western Europe. And today was kind of a meh day for here, those of us here in the U.S. So, all right. Well, let's bring up the market recap for today. S&P 500 stumbles as signs of tight labor market add to Fed fears. Get my notes. Here we are. The S&P 500 stumbled Wednesday as investors continue to worry about aggressive Federal Reserve rate hikes. The labor market remains tight just days before the monthly jobs report, adding fuel to bets that the Fed will be forced to step up the pace of rate hikes at its March meeting. The odds of a return to a 50 basis point rate hike in the Fed's March decision climbed to 80% following the data. The data comes ahead of February's non-farm payroll due Friday, which could still sway the Fed's thinking on whether to revert to a higher pace of rate hikes. Energy was the main drag on the market today, falling more than 1% as oil prices fell amid concerns about the impact of Fed rate hikes on the economy and energy demand. Valero Corporation, EQT, and Coterra Energy were among the biggest decliners in energy of the day. Tech remained above the flat line, led by a jump in semiconductor stocks, led by more than a 4% jump in AMD. On the earnings front, Stitch Fix fell 4% after the styling company reported a wider quarterly loss after revenue fell short of analyst estimates. Some analysts on Wall Street struggled to find reason for optimism on the stock and flagged several headwinds, including dwindling customers, margin pressures, and leadership uncertainty. CrowdStrike Holdings gained more than 2% after the cybersecurity firm reported better than expected quarterly results, as strong performance in January helped ease the challenging macroeconomic backdrop. Tesla slipped 2% after the U.S. National Highway Traffic Safety Administration launched a probe into two complaints over steering wheels falling off on the Tesla Model Y. Well, that wouldn't be fun to be like, driving around with a steering wheel in your hands. All right, so that's everything there. So again, looks like things are, some things are all right. It kind of depends on the where the winds are blowing that day. If people are worried that the Fed's going to continue to raise rates, technology and NASDAQ seems to suffer, and then the overall market in general. And when people get their hopes up that the Fed is going to be more dovish and not jack rates up any higher and maybe cut rates, which is what they're really hoping for, the market then rallies. So it's kind of out of its mind right now. All right. Next up, U.S. job openings stay elevated as labor market remains tight. U.S. job openings fell by less than expected in January, and the data for December was revised higher, indicating a tight labor market. The Labor Department's monthly job openings and labor turnover survey showed that 10.8 million jobs were available in January, down 410,000 from December. However, economists had forecast 10.5 million job openings. The report also showed that job cuts were higher than previously thought in 2022. Layoffs had reached a two-year high in January, and there was a decline in the number of people quitting their jobs. While there were job losses in finance, insurance, and construction sectors, there was job growth in transportation, warehousing, and utility sectors and non-durable goods manufacturing. The job openings rate fell to 6.5% from 6.8% in December, while the hiring rate rose to 4.1% from 4%, lifting hiring by 121,000 to 6.4 million. However, layoffs increased to 1.7 million, the highest level since December of 20, and more people were laid off than initially thought in 2022. The layoff rate rose to 1.1% from 1% in December, though it remains below the pre-pandemic high of 1.3%. Julia Pollack, chief economist at ZipRecruiter. Why does ZipRecruiter have a chief economist? That's a little odd. You'd think they'd have like a chief of HR and all that good stuff, but economist, I mean, are they doing like financial advice? Said that the level of layoffs coming closer to pre-pandemic average suggested the quote period of unprecedented job security for American workers is coming to a close, end quote. Fed Chair Jerome Powell said that the job openings decline did not indicate an improvement in labor demand and supply balance, and he affirmed his message of higher and potentially faster interest rate hikes. In February, the ADP National Employment Report showed that private employment increased by 242,000 jobs. The report from JOLTS suggests a strong labor market, but with some cracks, which may result in the Fed continuing to raise rates. Economists predict the labor market's upcoming employment report will show non-farm payrolls increased by 205,000 jobs in February, followed by a surge of 570,000 jobs in January, and that unemployment rate will remain unchanged at a more than 53.5-year low of 3.4%. So we shall see. I know I covered an article yesterday where they were talking about, we could lose 800,000 jobs could disappear. So we shall see. All righty. Last up on the docket, see if this is some fear mongering or if there's any substance to what this guy's talking about, or girl. Stock market will crash in 60 days. Best-selling author on Lehman collapse warns. All right. That's a guy. Market expert Larry McDonald has warned that a crash in the stock market could come in a matter of days after Federal Reserve Chair Jerome Powell indicated that the bank is not finished raising rates. McDonald, who is also known for writing a best-selling book on the Lehman Brothers collapse, stated that the Bear Traps report reports 21 Lehman systematic risk indicators, which examine equity and credit, point to one of the highest probabilities of crash in the stock market over the next 60 days. Let's read further. The withdrawal of capital from the middle-class families has been, quote, spectacular, end quote, due to the Fed's aggressive rate hike campaign to combat decades-high inflation. McDonald pointed out for every 1% increase in rates, $50 billion is taken out of the pockets of the middle-class families, and that auto loans are approaching 14%, with almost 20% of auto loans costing $1,000 per month. Mr. McDonald advised that the average American investor is making a smarter move by recognizing there is now a choice between stocks and bonds, with one currently being more profitable than the other. McDonald argued that investing $10 million in cash today generates $510,000 per year in treasuries. A year ago, the same investment only returned $70,000. He advised that investors who have been in the market for 2 years with moronic FANG stocks, and that's in quotes, that have gone nowhere should consider switching to money market fund or a 1-year treasury that returns $510,000 of risk-free interest. McDonald predicted that the market crash trigger will come from the S&P 500 earnings missing estimates big time. Wall Street is currently expecting S&P earnings of 226, which is priced for perfection. However, McDonald predicts the SP earnings will be around 190 due to job deterioration in the next 2 to 3 months, which will trigger the crash. Despite the warning, Powell has stressed that the central bank policymakers are prepared to pick up the pace of interest rates and would be prepared to increase the pace of rate hikes if the totality of data indicated that a faster tightening is warranted. So, yeah, we shall see if Mr. McDonald is correct, if the earnings numbers look down in the next couple of months, and we'll see. So maybe flag this one as or save it and you come back to it and check it out in a couple of months and see if that's actually the case. So, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. Hope everyone has a fantastical evening, and I'll talk to you guys next time. Adios.